Welcome all to meet again through the video that is related to economic analysis. The million-dollar question is this: how do we go about analyzing an economy? The working and dynamics of an economy can be systematically analyzed based on the steps outlined below. However, as an investor, we have to understand that these steps are mutually interdependent. For example, indicators give us an insight about the economic cycle of the country. In a similar way, economic policies directly impact the economic indicators of the country. The following dimensions will give us an insight into the overall health of an economy for investment: economic cycles, economic indicators, and economic policies. First one is economic cycle. The national output in India or of any country's economy does not rise or fall at a uniform rate. Our economy experiences a regular trade or business cycle wherein the rate of the growth of production, income, and the spending fluctuates over time. Statisticians calculate annual and quarterly movements in national output, and these are then tracked to measure the cyclical movement of the economy. All the stages in a business cycle are not decided by the government or any other influencing body, but by the market and the demand supply factors. So, it's very important as a first step to predict the phase of an economy in which you are going to invest. Phases of economic cycle. Let us understand the different phases of these business cycles. A country's economy does not grow continuously, but grows with different phases for a period of time, making it as one economic cycle. Following are the important phases of business cycle in the economy of a country: growth, boom, recession, depression. So, the cycle will always move from economic boom to economic slowdown, then to economic recession and the economic recovery. The relevance of learning the stages of cycle in an economy is very important for any investment. This cyclical movement is inevitable self-correcting mechanism of any free market economy. As India moved away from a failed centrally planned economic system called as socialism to a liberalized policy, the impact of these business cycles will be more prominent in the years to come. Economic growth and boom. This is a phase wherein a country's economy has a roller coaster ride with all around optimism reflecting through growing output, income level, GDP, employment opportunities, active lending and borrowing, and low rate of inflation. This phase is initiated by the recovery of the economy. The US had this phase in the 90s, and India got into this phase in the new millennium with the slogan "India is shining." A boom occurs when national output rises strongly at a rate faster than the trend rate of the growth, or it is called as long-term growth rate of the country. In boom conditions, output and the employment are both expanding, and the level of aggregated demand for goods and services is very high. Typically, businesses use the opportunity of a boom to raise the output and also widen their profit margins. The characteristics of an economic boom are strong and rising level of aggregate demand, often driven by the fast growth of the consumption, rising employment and real wages, high demand for imported goods and services, a rise in government tax revenues, company profits and investment increases, increased utilization rate of existing resources, danger of demand pull and cost push inflation if the economy overheats. Economic recession and depression. A recession means a fall in the level of real national output, that is, a period when the rate of economic growth is negative. The national output declines, thereby leading to a contraction in the employment, incomes, and profits. It is a phase wherein a significant decline in economic activity spreads across the economy, lasting more than a few months. It is normally visible in real GDP, real income, employment, industry production, and wholesale retail sales. A lengthy recession cycle would lead to depression. The US economy is said to be in the recession stage as it is characterized by a fall in industrial output, income level, growth, and unemployment. The characteristics of economic recession are declining aggregate demand for countries' output, contracting employment or rising unemployment, sharp fall in business confidence and profits, and a decrease in capital investment spending. Destocking and heavy price discounting, reduced inflationary pressure and falling demand for imports, increased government borrowing and lower interest rate from the central bank. Economic indicators. An economic indicator is simply any economic statistics such as unemployment rate, GDP, or the inflation rate, which indicates how well the economy is doing and how well the economy is going to do in the future. Economic indicators allow analysis of economic performance and predictions of the future performance. One of the applications of economic indicators is to study the economic cycle. Economic indicators include various indices such as earning reports and economic summaries. Example, unemployment rate, housing statistics, wholesale price index. It is a measure for inflation. Industry production, bankruptcies, gross domestic product, broadband internet penetration, retail sales, stock market prices, money supply changes, etc. If a set of economic indicators suggests that the economy is going to do better or worse in the future than previously expected, the investors may decide to change their strategy. Economic indicators can have one of the three different relationships to the economy. Relation to the economic cycle, frequency of the data, and finally, timing. Relation to the economic cycle. Pro-cyclic. A pro-cyclic or pro-cyclical economic indicator is one that moves in the same direction as the economy. So, if the economy is doing well, this number usually increases, whereas if we are in a recession, this indicator decreases. The gross domestic product GDP is an example of pro-cyclical economic indicator. Counter-cyclic. A counter-cyclic or counter-cyclical economic indicator is one that moves in opposite direction as the economy. The unemployment rate gets larger as the economy gets worse, and so it is a counter-cyclical economic indicator. Acyclic. An acyclic economic indicator is one that has no relation to the health of the economy and is generally of little use. For example, an oil exploration company has found new reserves in the allocated block whereby the company's prospect increases. This has no relationship to the health of the economy, and so we would say it is an acyclical economic indicator. Frequency of the data. In most countries, GDP figures are released quarterly, that is every 3 months, while the unemployment rate is released monthly. Some economic indicators such as Sensex or Nifty are available immediately and change every minute. Timing. Economic indicators can be leading, lagging, or coincidental, which indicates the timing of their changes relative to how the economy as a whole is changing. Economic indicators can be classified into three categories according to their usual timing in relation to the business cycle. Leading indicators. Leading indicators are indicators that usually change before the economy as a whole changes. They are therefore useful as a short-term prediction of the economy. Stock market returns are leading indicators. The stock market usually begins to decline before the economy as a whole declines and usually begins to improve before the general economy begins to recover from a slump. Lagging indicators. Lagging indicators are indicators that usually change after the economy as a whole does. Typically, the lag is few quarters of a year. The unemployment rate is a lagging indicator. Employment tends to increase 2 or 3 quarters after an upturn in the general economy. Coincidental indicators. These are the indicators, those which change at approximately the same time as the whole economy, thereby providing information about the current state of the economy. Personal income, GDP, industrial production, and the retail sales are coincidental indicators. A coincidental index may be used to identify after the fact the dates of the peaks and troughs in the business cycle. In short, when you analyze the economic indicators, you have to consider them based in the relation to economic cycle, the frequency of the data, and also its timings. Economic policies. Policies are designed by different ministries and regulatory authorities to direct the economic activity. Economic policies are designed according to the phases of business cycle. It may be contraction and expansion, prevailing at that point to meet the economic objectives of the country. Fiscal policy. This is presented by the finance minister for the coming financial year in the parliament before the end of a current financial year. It is the plan of the government for expenditure, revenue, and borrowing. It is also known as union budget. The term fiscal policy refers to the expenditure of government that it undertakes to provide goods and services and the way in which the government finances these expenditures. There are two methods of financing: taxation and borrowing. Monetary policy. This is presented by the Governor of Reserve Bank of India, that is RBI, after the fiscal policy, by which the RBI seeks to ensure price stability for the economy. Usually, the fiscal policy and the monetary policy target similar economic problems like increasing inflation, GDP growth rate, unemployment, and foreign exchange, etc. Industrial policy, agricultural policy, export-import policy, and foreign investment policy are the other forms of economic policies presented by the respective ministries at the state and central level. Important considerations for the policy makers before designing an economic policy are as follows. What are the economic objectives of the government? What is the current economic scenario in terms of economic indicators? What is the economic forecasting? So, as a good investor, you have to start watching the economic cycles, economic indicators, and also the economic policies of the government as announced from time to time. You will then start developing a direct relation with these economic factors, business development, and the stock market. Thank you. Hope the session was informative.